job of a research team is to liaise with all of our colleagues across asset classes and regions to try and identify what the opportunity set is for our customers.
In asset allocation, we try and think of the world in as simplistic form as possible. We use a market diamond approach, which is you have growth expectations, which drive inflation, which drive central bank policy, which then drive market risk premium. And of course, there are feedback loops between all four quadrants of the diamond that matter a lot for markets.
We've just come out of the longest expansion in post-war history, and it's bound to come to an end. And the question for investors is timing that. The way we think about that is when the output gap or the amount of spare capacity in the system has been used up, generally the risk is that you're going to move into a slowdown. We think the market's going to continue to prove correct by pricing in that slowdown, and the economic data will support that.
So when we move into a slowdown regime, a key question for investors is, where do things go next? And a key thing to understand there is about the feedback loops from slower growth. In particular, where are the risks in the global economy? We've seen the market shift regimes. So previously it was in a regime where growth was running above trend across G4 economies, developed markets. And we're shifting now into a regime where growth is heading sub-trend, and the market's starting to price that. And I think the next 3 to 6 months will be about the market adjusting to the second round effects of that. So policymakers becoming more dovish, potentially leaning towards easing biases, and risk-free rates potentially starting to rally from here. So we are still very cautious on risk assets and turning quite bullish on rates.
We're beginning this slowdown phase from a very low level of inflation compared to historic norms. That's going to present a significant challenge to central banks in terms of easing monetary policy sufficiently fast and sufficiently aggressively to stop that process of slowdown occurring naturally. Central banks are going to be faced with a hell of a challenge of reflating expectations again, because we may well see across the developed markets inflation going below zero.
If you look at the last 3 Fed cutting cycles, they tended to cut rates by about 500 to 600 basis points. So the lack of policymaker ammunition this time around means that central bankers could have to resort to even more unconventional policies next recession.
And related to that, we're concerned about liquidity conditions in markets and where risk premia are currently pricing, and therefore that the right positioning for us is long interest rates and government bonds, and still quite defensive on equity markets and things like high yield and emerging markets.
The kind of problems and structural issues that are at root here are pretty significant, and they're very hard to solve.
The key message, I suppose, would be that we're not done. This is a classic cyclical end game, and it's got to run through its normal course. The question is how deep and how hard. And I guess at the moment we're kind of saying it's not going to be a terrible economic outcome, but possibly markets need to re-rate a wee bit further.
I think that's it.